Welcome to the Q4 2016 macro view walkthrough. As I stated in the email that went out, if this is something that you're still interested in seeing going forward, please let us know. We're more inclined to start expanding the monthly updates to include more macroeconomic data, as well as recaps of what occurred during the month and what we're looking forward or what we're looking to going forward for the coming months. So please let us know, reply, and let us know your thoughts on whether you want to keep receiving this. Disclaimers, I'm not going to read this whole thing, but we're not making specific recommendations, and every person should consult their financial advisor to ensure that whatever recommendations they're receiving are appropriate for their individual circumstances. From a 1,000-foot view, growth is re-accelerating, although moderately. The data is improving moderately. U.S. stocks are still highly valued or overvalued, as some would point to on a historical basis. Europe is improving as well, but there's still risks, and there still is a global currency war happening. Moving on to market metrics and statistics, from a 3,000-foot view, the price to earnings multiple of the S&P improved ever so slightly. We're now at a 22.5 trailing 12 months. And if you look at the CAPE measure, the Shiller CAPE, which is the cyclically adjusted price to earnings multiple, that stands at a 27.7. Again, there was a slight improvement over the prior quarter. Last quarter, it was almost 24 on the trailing 12 months, but we had some improvement in earnings, even though the markets did, rocket higher in November and December. This is something that we highlight each quarter. So this is showing secular market trends, secular meaning very long-term trends in the markets going back to 1900. According to Crestmont Research, which does this analysis, they believe that we are still in a secular bear market that started in 1999 or 2000. Since what marks typical secular bull markets are very low price to earnings multiples, as you could see here, and secular bear markets start at peak price to earnings multiples, like you can see here in 1999, 2000, as well as here in the early 70s. 720 Global, they're a firm that we picked up this research note from. They show in green the Russell 2000, which is predominantly small cap stocks. And they'll show their net income in the black line. So you saw, 2007 during the Great Recession, 2008, there was negative earnings, negative net income. It rebounded, and then it peaked in 2013, 2014, and has since fallen over, even though the Russell 2000 has gone up in value in terms of market cap. So I'm not going to read this whole thing, but from what you can see is the PE that they calculate is 46 for the Russell 2000, even though the reported price to earnings multiple is much lower, since they strip out companies with negative earnings, and there's a lot of small cap companies with negative earnings. They include both those companies that have positive and negative earnings. So under their metric that they look at, even from a market cap to net income measure, the market in terms of the Russell 2000 according to 720 is highly overvalued. Goldman Sachs created an upside case due to the Trump presidency of higher interest rates, tax policy changes, and so their upside case for the S&P for next year is $130 per share, $130 in earnings for the S&P for the year. So if you look at where we're at today, we're at about a 23 price to earnings multiple. So if that multiple continues, 130, you multiply that by 23 and you get the S&P at almost 3,000. Currently the S&P is around 2,300, so that would be a pretty large move. If the market stays the same and the earnings actually end up being $130 a share next year, as Goldman potentially predicts, then the market would still be at an 18 trailing multiple, which is still, it's higher than the average, but it's not, it's certainly better than where we're at today, which is about a 22.5 multiple. This was another chart that we picked up during the month that shows the S&P 500 the price to sales ratio historically going back to the early 60s or mid 60s. And what it shows is that the ratio is the highest it's ever been. The average is about 0.9. And so, again, another measure showing that we're in a very, very expensive market. Corporate profits after tax, year-over-year change has started to pick up. You know, we did peak. If you look at, I believe we have another chart here. If you look here, we peaked in, mid 2014, and then profits started to roll over. This is an aggregate number. This just shows billions of dollars. The other chart shows year-over-year percent change, which I believe is important. And so profits have started to rebound, corporate profits. You can see here it's starting to break and go positive. They're recovering. It's too soon to tell if it's going to continue. You'd see corporate tax receipts actually have been falling though. So, there's some nuances and differences in these numbers which make some things a little bit hard to tell what's actually occurring. The S&P has continued to climb while the corporate tax receipts are falling. So, interesting chart. This is the total net tax receipts, the year-over-year change relative to GDP. So, falling tax receipts could portend a fall in GDP. Economic optimism index. This is what IBD, Investor's Business Daily, calculates, and it's the highest it's been in 8 years. Confidence is up across, business confidence, small business confidence. All those readings are higher. We'll delve through that in a little bit. This is just a chart of the 10-year Treasury. They calculate it as what's called the constant maturity rate. And over the last 30 years, we've marked it from 1988, but the bull market really started in the early 80s when Volcker made, crushed inflation with, 16% interest rates or so. So there's been a steady trend going back to the mid 80s where the 10-year Treasury rises, falls again, and it's been within this trend line, and it's, risen the most that I've really seen in a very short period of time for the month of November. Once Donald was elected. Now, there's been a lot of press that the bull market's over. That happens every time rates rise, and they've fallen, subsequently. Bill Gross recently said 2.6% in the 10-year Treasury is more important than Dow 20,000. I believe him, and I think that's an accurate statement. We need to watch these levels closely. It could be the end of the bond bull market. It's way too early to really ring that bell and say that it is. A lot of economists that we read and follow think that, while there are some positive signs with inflation and certain data points improving, you have a lot of long-term headwinds like the level of debt in the country, unfunded pension liabilities, and a variety of other factors that lead them to think that you're going to see a retracement of lows in the 10-year Treasury and 30-year Treasury. Gary Shilling, who called the bond bull market in 1981 and subsequently back then said that he thinks that 30-year Treasury will hit 2%, the 10-year will hit 1%, and he still believes that today, that we will see that in the future. Moving on to just some macroeconomic data in the U.S., we've showed this chart in previous macro walkthroughs. It shows currently we're 90 months into this expansion. We'll probably end up surpassing this prior expansion and be the third longest on record. This blue line here, this shows you the aggregate, the cumulative GDP in this expansion, which is incredibly weak. And so in a historical context, we've had incredibly low growth, and a lot of people would point to the high levels of debt in the country. And so civilian unemployment rate and wage growth. So traditionally in the past, once employment starts getting lower and lower, as we have been, you start seeing wage growth pick up. As there's more dollars chasing fewer laborers. And so at various points in time, you'd see here, once unemployment starts from a high point and drops down and goes below 6% and continues, you start to have wage inflation. Same thing here. It happened right around 5.8%. Inflation starts to pick up, or wage growth, excuse me. Same thing here. You have a recession, unemployment rises, peaks starts to fall again, wage growth picks up. But here you've had a steady drop, and we've had, some wage growth pick up over here, but not much. So we'll see if this trend continues and unemployment stays low. You may see wage inflation start, which is what the Fed, I think, is looking for and hoping for. Since that's, just going back here, wage inflation has, in terms of like real CPI adjusted wage growth in the US, has been incredibly weak, while consumers have had to deal with higher expenses for rent and healthcare, which eats into discretionary cash flow. This shows a civilian unemployment rate and a natural rate of unemployment. So the US unemployment rate is now firmly below that natural rate, which is when they believe inflation is expected to pick up. So if you look at, go back to those previous slides, these points tend to coincide with that wage growth that we saw in the previous slides. ISM non-manufacturing, again, that's important. Services make up most of the economy in terms of GDP. It's rebounded. We thought we may have seen a contraction in 2016, and we thought data was going to continue to deteriorate. It hasn't. It's rebounded. So we'll kind of see where it goes from here. But now the expectations for GDP have risen in the near term. Capacity utilization is low, and it does remain weak. And inflation expectations have increased, and some measures of inflation have increased. But in terms of whether we're going to see a sustained pickup in inflation, a lot of folks say, well, there's incredible slack in the economy, and until you remove that slack, then it's hard for inflation to really pick up and take hold. So we'll watch capacity utilization closely. Industrial production, it's still waiting for recovery. It's been relatively flat since 2015. Another very important metric. And so we'll usually, at least in the past, you look at these past data points, when you've had significant contraction in industrial production, it's been met with a recession. CPI for all consumers, it has increased. It's approaching 2%. When you start looking at the individual components, though, so that you strip out food and energy, they're volatile. That's what the Fed typically looks at. They're hoping for a 2.5% target, which we're slightly under. And as I said, you look at medical care. Medical care hit 5% recently. It's been the primary driver, along with owner's equivalent rent, of the increase in CPI. So you look at owner's equivalent rent. So the Fed doesn't calculate home price increases for inflation. They factor what you could rent your home for. But all statistics point to, if you look at all the stats, rents are increasing, home ownership is declining, the amount of people that are renting are increasing. And so it's only natural, as people are renting more, you're pushing up the price of rent. So if you look at the CPI, most of those increases are coming from those two components. Velocity of money versus the labor force participation rate. This was just an interesting chart someone put together that I haven't seen looked at before. So labor force participation has gone down. A lot of that is retiring baby boomers, but you see the velocity of money, which is falling and getting lower, seems to be tracking the labor force participation rate. The manufacturer's new orders, non-defense capital goods, excluding aircraft, this has been, stuck at around 0 to -5% for a while now. Again, another important metric that doesn't seem to be improving. Durable goods orders, that's been relatively flat, sluggish. We'll look for that to increase before you really start seeing a lot of inflation and higher GDP estimates, really high GDP estimates, think 3, 4, 5% like you did see, in this era of time when you had 10%, on average. If you drew maybe a regression line, it'd be 7 to 8% in this range, where now we're probably right around flat. Import pricing relative to the CPI, again, they've started to increase. High correlation between CPI and import prices. Again, we may see higher inflation if this occurs, and maybe go beyond the Fed's target. core PPI, producer price index, has been rising as well. The delinquency rate on commercial and industrial loans, that had a spike coming into this year. It's been flat for most of 2016. This is an important measure of obviously stress in the economy. If more people are defaulting and being delinquent on payments, that tends to foreshadow recessions or coincide with them. Real disposable personal income, as I said, that's been decreasing. I've been talking to clients, friends, and anyone that would listen to me for a while that the middle class has gotten really, really squeezed. You know, if you make a good living, let's just say it's 100 or 150,000, and you have a family of four, you've gotten squeezed due to higher rent or incredibly high medical costs, if I've seen personally. So, you know, until you see wage growth pick up as well, the middle tends to get squeezed as well as the poor. The trade-weighted dollar index, that's gone up recently. Obviously, post-election, it was rising before that as well. A rising growth limits exports. It makes our goods less competitive overseas, and it could put a limit or a headwind to inflation. And so there's some positive signs and green shoots in the economy as well as headwinds. Not everything is pointing to sunshine and rainbows. There's a lot of kind of mixed data out there. This was a chart from even before the election that showed the Clinton estimate, current, as well as the Trump estimate in terms of debt to GDP levels, which obviously they're forecasted to increase dramatically under Trump. This just shows an analysis, a breakdown in a different way of the expected fiscal packages that you could see, corporate taxes, federal spending. So what they're expecting is only an output effect of 0.5% on GDP. Again, we'll see. There's another week or so until President-elect is actually in office, and then we'll start to see some, maybe realize some of the policy that he's going to actually come out with. Just a few international stats. That the Bank of Japan is buying Japanese stocks like crazy. You see that the value of their holdings continue to swell. So you could see that as a tailwind to Japanese stocks. Obviously, the yen and the Nikkei have a very, very strong inverse correlation. When the yen is falling in price, the Nikkei is rising as well. You do have Bank of Japan buying tremendous amounts of stocks. That stands now at about 14 trillion yen, which is about $1 trillion US, give or take. Just shoot from the hip. Excuse me, that's not true. 100 billion. Loans by another name. So China, what they've done is these Chinese banks, they've increased what they call investment receivables. So instead of being able or having to set aside funds for potential losses, when you hold these loans on their balance sheet as investment receivables, they don't have to hold anything. And so these have been increasing and have increased substantially from 2014 to 2015 and now represent almost 20% of total loans. I continue to see more and more stats coming out that show the percentage of the amount of loans that are occurring in China is just increasing at such a rapid rate. Corporate debt is growing faster in China than it did in Japan during their bubble period. So I've shown what's happened with government debt in Japan. This is a view of corporate debt, and it's been climbing as well. And so, there appears definitely to be a buildup in debt between real estate loans, government, and corporate debt. China PPI is increasing year over year. That's gone into the positive territory. If you look at inflation statistics, PPI, CPI, PMI, all of these stats globally have improved recently. Again, we've seen some slight revisions in GDP estimates and inflation estimates globally. It's still too early to tell whether you're going to see that continue for years to come or whether or not this is just, a small reversal in the longer term trend of lower prices. Again, this is a JP Morgan chart of global manufacturing PMI. That's again been improving. So as I had said, we've seen some global estimates for GDP and inflation increase for the first time in many years. You could see this chart of PMI has generally been on a decreasing trend. Now it's been increasing and it broke trend. So we'll see whether or not this is, again, something that will continue far into the future, whether or not this is just a short-term break. Well, that's it for this this quarter's Mac review. Again, please let me know if this is something that you'd like to continue receiving. Otherwise, we're going to, like I said, we're going to expand our monthly updates to include a lot of these charts and delve into a little bit more detail on these on a monthly basis. Thank you very much. If you have any questions, please contact us. Reply to this email. Thank you.